Hello and welcome to the 20-Minute Ag Manager. My name is Liz Higgins and I'm an Ag Business Extension Specialist with Cornell Cooperative Extension's Eastern New York Commercial Hort team. And today we're going to talk about balance sheets. So a balance sheet is just a systematic way of showing what you own and what you owe. The difference between the two is your wealth. In all financial accounting systems, including the balance sheet, the goal is to organize information so that anyone looking at it would reach the same conclusion about your business's financial condition. My goal with the next few webinars is to help you know how to input your information into your system correctly. In a balance sheet, you're concerned about your assets, those are the things you own, your liabilities, those are the debts that you owe, and your equity, this is your wealth or investment in the business. So assets are anything that you have that has value. Assets are divided up into short-term assets and long-term assets. Short-term assets are things like cash or other items that are likely to be converted to cash within the fiscal year. Your checking account would be an example of a short-term asset. Money that people owe you this year, so those invoices you've sent out is also a short-term asset. Long-term assets are hard to sell quickly. They tend to be the key components to your business. They are the machines you need to do the job, the cows you milk, your lands and your land and your buildings. Another good example of a long-term asset would be your slot at a farmer's market, so it doesn't have to necessarily be a tangible piece of property. Liabilities are the debts that you owe. Once you actually pay the debt, it stops being a liability and it becomes an expense in your system, and we'll talk about that in the next webinar. Like assets, liabilities are divided into short-term liabilities, generally due within the fiscal year. Things like bills, your rent due, your taxes due, your wages due would all be liabilities. Long-term liabilities are the debts that are due after this year. Your mortgage and multi-year loans would be a long-term liability. A multi-year lease would be a long-term liability. Future years' payments on an insurance policy contract would be a long-term liability. So equity is the initial investment in your farm business. When you first started the business, most likely you needed to have some money to buy inputs or to pay workers that wasn't borrowed. That money from the outside is your equity. Equity also measures and tracks your wealth, which is the difference between your assets and your liabilities. So in the balance sheet, assets is equal to liabilities plus equity. In the balance sheet, and we talk about it balancing, right? The number on the left-hand side of your equation, your assets, has to be the same as the numbers on the right side of your financial equation, your liability and your equity. If they're different, you'll either have to add or subtract from your equity to make them equal, assuming that you haven't made any input or math errors. So here's a quick example. Assets equal liabilities plus equity. And you can see in this example spreadsheet, this balance statement here, that the assets at $1,275,000 is equal to the liabilities at $850,000 plus equity at $425,000. So you can see this balance sheet does balance out at $1,275,000 is equal to $1,275,000. And when you see this, you can be pretty confident that you have entered your information in correctly. So we've talked some about assets and liabilities, so let's talk about what types of business transactions would affect your farm's equity. For example, does purchasing a new tractor actually affect the equity of your farm business? And the answer is no. Actually, buying a tractor doesn't change your equity at all. If it's a cash purchase, you've just converted a short-term asset, cash, into a long-term asset, the tractor. If it's financed, the loan to pay the tractor, that increase in liability, would be the same as the increase in the asset, the tractor. And the reduction in cash, for example, if you had to pay for the tractor. So, for example, in this case here, if it was a $60,000 tractor and you borrowed $40,000 and then paid $20,000, you can see that the $40,000 liability on the right-hand side of the equation is the same as the $60,000 tractor on the left-hand side minus the $20,000 in assets that from your checking account, for example, that you had to pay for the down payment. So it's $40,000 is equal to $40,000. And there's absolutely no change at all in equity in this type of a transaction. So why would equity change then? Equity changes as you have profits and losses from your production activities. A profitable business should see equity growth over time. As you make sales and money comes into your accounts, as people start to pay you, you should have more money coming in than the money that you spend out in expenses to produce whatever it is you're producing. So you should start to see an increase in assets compared to your liabilities. And in order to make that balance out, you would then see an increase in equity to make the equation balance out. Another reason why you could see a change in equity is you sell an asset for a different value than what is on your balance sheet. So you would have to adjust your equity to reflect that gain or loss in the value of that asset. For example, land values can increase or even decrease sometimes. And that increase in your assumed value of that land would then also increase, that asset increase would increase your overall equity increase. And then as you add or withdraw capital into the farm, that would reduce or increase your equity. If you get an inheritance and you invest that money in your farm business, that would increase your equity. That would be an equity investment. But as you take money out of the business for living expenses, to go on a trip to Europe, to maybe buy yourself some other type of non-business investment, a retirement account, that could be a reduction in the equity in your business. But it doesn't mean your overall family wealth is changed, but your business wealth may have gone down a little bit. And the latter two reasons are why balance sheets don't directly measure the profitability of a business activity. Balance sheets actually just measure the what you owe and what you own and your overall wealth at a specific point in time. And we talked about asset values changing. One of the ways that asset values change is through depreciation. Depreciation affects the value of an asset. Depreciation is the annual loss in value of an asset due to use and wear and aging and technical obsolescence. When I buy a computer for $2,000, 5 years later, that computer is no longer worth $2,000. It may be running fine, but it may be technologically obsolete. Depreciation is also the link between the income statement that measures income and expenses and the balance sheet. Depreciation is a way of spreading out the cost of an asset, the value of that asset, to the expenses in the business. It could be the use of a tractor for producing a crop. So you don't expense the full value of a tractor in the first year that you purchase it. You spread the cost of that tractor over all of the years that you are actually using it. So what types of assets do you tend to depreciate? These would be things like machinery, equipment, buildings, fences, breeding livestock, perennial crops, irrigation wells, land improvements, building improvements. Basically, the rule of thumb with depreciation is it would have a useful life of more than a year. And it also has to be something that the useful life can be determined. It's not unlimited. So land is never depreciated because it has an unlimited life. It is not assumed to wear out. There are a ton of ways of tracking and handling depreciation, and this is really not a class where we're going to go into any depth with that. The simplest way of thinking about depreciation is what they call straight line depreciation. It's a constant amount of depreciation each year for the use of that piece of equipment. Let's say a tractor costs $60,000. Salvage value is what it'll be worth at the end is $30,000, and you're going to use it for 10 years. So you would take the initial value minus the salvage value, which would be $30,000, and that's how much of it you're going to use, and then divide that over 10 years, and you would depreciate that tractor value in your balance sheet every year by $3,000. You would take that depreciation out. But this actually depreciation can create a challenge with overlooking at a business's balance sheet. Because as you can sort of maybe have thought, as I talked about straight line depreciation, if you're taking a piece of equipment and you're reducing its value by a fixed amount every year, sometimes things don't really change like that. You can have an asset that you could purchase that could actually increase in value even as you're using it. Its market value may be very different than this, sort of regular depreciated value. So what do you do if you're really trying to use your balance sheet to assess your overall wealth? Do you use cost basis, which would be the purchased cost minus the regular depreciation for the value of that piece of equipment? Or do you take the market basis, which is the current market value of that piece of equipment. And actually, you should really use both. They're both completely valid and very useful ways of thinking about and capturing the value of those pieces of equipment. So let's dig into that a little bit more. Cost basis is the asset value of that piece of equipment minus the annual depreciation. And so the main advantage of cost basis is it's really a representative of how you're using that equipment. You're not distorting your equity based on external changes in asset value that are totally unrelated to your business practices. So for example, your equity really reflects your business investments and their use, not some random change in valuation like land values going sky high or something like that that is beyond your control as a manager. The disadvantage is that it can really misrepresent the true value of a business because that asset value may not be related to the market value. That land, well, you don't depreciate land, but that like tractor, let's say you've got an old tractor and it looks like it would be fully depreciated because you've had it for years, but now they're very collectible and it's actually worth, twice what you even paid for it. You've actually got more wealth than just the cost basis would tend to represent. The market basis, the main advantage to it is it's a much more accurate measure of your real current financial health and collateral that you have available for loans. So it really does capture your actual wealth. The disadvantage is asset prices can really hide management problems because you can have equity increasing, just based on the value of some of your infrastructure increasing when you're not actually adding to equity based on increased income and money that you're generating from doing the business. So it can, you can have a business that has tons of wealth, but all of that wealth is from external things like land value increases and infrastructure increases, and not at all to do with how the business is actually doing. So what use is a balance sheet? Balance sheets are useful for looking at liquidity and solvency, which are the overall health of the business. And balance sheets also, you do need to remember that they are most useful when you're comparing that business at the same point in time over time, because seasonality can really affect how a balance sheet would look. And if you just sort of use your imagination and picture what a farm's balance sheet might look like if it's a cropping farm in June when it's spending a lot of money and it doesn't have a lot of money coming in, and maybe it's got some operating loans and things like that, compared to that same farm in November when a lot of bills have been paid, revenues coming in, operating loans have been paid off. So seasonality means that comparing balance sheets randomly at different points in time is not as useful at all as comparing the balance sheets at the same point in time. And that's generally why banks and financial people will want to see maybe end of the year balance sheets or quarterly balance sheets that are run consistently over time to get a sense of how that business is operating. And financial software makes that very easy to do. So let's quickly touch on a couple of ratios that you can calculate from your balance sheet. One is the current ratio, and that measures the ability of the business to meet its financial obligations as they're coming due without disrupting the business. So it looks at your ability to generate cash in the short run. And the current ratio is just the ratio of your current assets, or those are your short-term assets, divided by your current liabilities, your short-term liabilities. So it's the money that you have access to right now divided by the debts that you're going to owe really soon. And that ratio says, are you going to be able to pay those immediate debts with your immediate money? And so if you have too low a current ratio, you're likely to have cash flow problems, right? So you might not be able to pay your current debts with the money that you have on hand. If you have too high a current ratio, and this is a problem, that we all should have, and I'm being sarcastic, is that you are holding too much money in low interest rate investments compared to putting some of that money into longer term assets or more better financial, things that will give you a better financial return. So you're losing money essentially by keeping cash under the mattress is a way that it can be phrased. But the former problem is the more significant problem. So what's a good current ratio? Typically farms, University of Iowa found that have adequate liquidity have current ratios of about 2. when you do the ratio. Farms that have continuous sales like dairy, where there's cash coming in all the time, can have current ratios as long as 1.5. Farms that have really concentrated sales at the very end of the year are going to need a much higher current ratio early in the year in order to show that they've got enough cash to sort of get them through those long periods of time with no cash coming into the business. So that's something that a lot of you may want to do, would be, if you're a cash farmer, just run your current ratio at the beginning of the season and see, like, are you somewhere near a 3 or are you down near a 1.5? If you're closer to a 1.5, maybe next year you need to set yourself up to have more cash on hand at the beginning of the season. Solvency measures your overall business health. It's really your ability to pay back the debts that you have and to have equity in the business. One of the solvency ratios is your debt to asset ratio, and that's your debts divided by your assets, total liabilities divided by total assets. It's the proportion of the business owed to lenders. Closer to 0 is better, because that would mean, and the ratio really should be between 0 and 1. 0 means you've got no debt. That means your assets equal your equity. 1 means debts equal asset. That means you don't have any equity. And if you have greater than 1 debt to asset ratio, that means that your business is insolvent. That means that your assets, you have less in assets than you have in liabilities and equity. You owe more money than you even have. And that's really bad. Lenders don't like to see that. Equity to asset ratio is sort of the flip. It's the proportion of assets that are owed by the farm. So it's the opposite of debt to asset ratio. Closer to 1 in this case is better, and the ratio should be between 0 and 1. 1 means assets equal equity, so the owner has no debt. 0 is no equity. That's the same as debt to asset equals 1. That means the bank owns it all. And less than 0 means the owner has negative equity in the business. And once again, that's where you owe more money than you even have in equity and assets. And then finally, debt to equity ratio is the proportion of financing that lenders provide compared to what's provided by the owner's equity. A lower number is better. 0 means no debt, and means 100% owner equity. The owner owns it all. They have no debt. They have no liabilities. And then the upper number can be infinitely large as equity approaches 0. So a low number, like a 0.75, means for every dollar of equity financing you provide, your lender is providing 75% of financing. A 1 means you and your lender are providing equal proportion of financing. And then higher numbers mean that the lender is providing more financing for every dollar you put in. A very large debt to equity ratio implies a very small equity from the owner and a potential for insolvency, that you don't have a lot of skin in the game. So these are some ratios that University of Wisconsin-Madison has, but the ratios are going to be, as we sort of touched on with cropping versus dairy farms, different ratios, different kinds of farms will have different ratios. Different business stages will have different ratios. You would expect to see more liability, more debt in a startup business compared to a mature business. And so these are just rules of thumb. These are not, these are sort of, a lender will look at these ratios and then dig more deeply into your financials to figure out why and whether this is really a signal of a problem or whether there's other factors that can explain why a ratio might look like that. So in the next video, I'm going to be talking about income statements. They're the balance sheet's other half, and the income statement provides information about the day-to-day operations of the farm's business. It looks at income and expenses and how you use that to assess profitability. So thank you very much.